This is Andrew Stotz of Stotz Investment Research, and today I'm going to talk about how tiny interest rate hikes are painful for the US government. Now, let's look at the chart in more detail. First of all, you'll see that the yellow bar is the amount of debt that the US government has. So in about 2008, just before that crisis, or 2007, the government had $10 trillion in debt. Today, in 2016, 2017, the government now has $20 trillion in debt. Now, if you and I were to borrow that much money for our company or individually, our interest rate would be so high that it would consume all of our monthly spending, right? But that's not the case for the US government. If you look at the red line here, what you're going to see, I've calculated the government's interest expense, the amount that they're paying, as a percent of the total expenses they have every single month. And what you're going to see is, despite the fact that the total amount of debt rose dramatically, it doubled, there was almost no increase in the amount of debt payment or interest rate payment that the government had to make. Well, they were lucky about that, because certainly it could have been very expensive. How did that happen? Well, that takes us to the blue line. And on the blue line, what you're going to see is that the government just kept lowering and lowering and lowering the interest rates over that period of time. Short-term rates were down to zero for almost a decade, and long-term rates just kept coming down. Now, the government doesn't borrow only short-term. They borrow a blend. Mainly, it's a mid-term borrowing these days. So let's say the government's paying about 1.7% on its total debt. Tiny amount. So now, let's take a look at that. I say that that tiny amount of 1.7 is a crazy low amount of interest that they're paying on that debt. The next thing to look at is that it's these low interest rates that allowed the US government debt to double with no rise in interest spending. That was amazing. And that leads us to where we are today, which is a very possibly painful situation. Because if rates were to slowly double, and that's what I've done, the blue line I've increased slowly over the next few years, and then I've asked the question, what would happen with government interest expenses as a percent of total spending? And what I found was that it would go from about 5% to about 10%. And that's doubling when it's time for instance, the Trump administration may be trying to cut the amount of spending that they do. Well, they can't cut this part, and therefore it would mean other parts would have to be cut. So overall, the US government is in a difficult situation. Sure, a decade of zero interest rates for short-term money fueled the economy and prevented a complete collapse. But now the adjustment back to normal rates has a constraint, which we can see right here.